Oftentimes in the investing community, we hear about how great stocks like Visa and MasterCard are, and to be fair, I actually own a lot of Visa stock. I absolutely love the company. But we don't hear about American Express nearly enough. This is stock ticker AXP, currently trading at $248 per share, and look at this, over the past year, now up over 56%. Now let's put all this into a little bit of perspective. When it comes to top credit card networks in the US by purchase volume, we can see Visa is by far the largest player and MasterCard is the second largest. And then we have American Express at the third largest. So this kind of puts this into perspective. Now, if we look at some more historical data, over the past 5 years, the company's up around 100%, and over the past decade, up around 177%. Now, when we talk about American Express, there's a few key differences you have to understand that makes it very different from Visa and MasterCard, and in fact, I think some would argue that it gives them a competitive advantage. Now, to start off, let's go ahead and look at the dividend metrics because they're actually a little bit different from Visa and MasterCard. And when I plug in the stock ticker, you can see all this data will automatically load in thanks to the help of the ticker data add-on. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on, then you can head over to tickerdata.com at the link in the description and get a 7-day free trial. Now, we can see the starting dividend yield for AXP is a little bit higher than that of Visa. It's sitting at 1.13%. And they've also seen double-digit dividend growth over the past 5 and 10 years. So yes, they are increasing those dividend payouts, but what I really like also is a very, very low free cash flow payout ratio, even lower than Visa. It's sitting at just about 10.5%. So keep in mind, remember, a company can do 5 different things with free cash flow. They can reinvest back into the business, which all companies should be doing. They can pay down debt. They can pay out dividends. They can buy back shares and then of course attempt mergers and acquisitions. So with American Express only using 10.5% of their free cash flow to pay out dividends, they have about 90% of their free cash flow left over to reinvest back into the business and also buy back shares, which actually if we jump over to my stock screener and come up here and plug in AXP, we can see this is actually something the company has been doing pretty aggressively. They have bought back a lot of shares over the past decade, going from about 1.08 billion to the end of 2023 all the way down to around 735 million. So they've bought back over 25% of their outstanding shares in the past decade. That's going to provide a huge boost to shareholder returns. Jumping back over to our dividend breakdown sheet, we can see a nice long history of increasing those dividend payouts. Again, we already touched on the double-digit dividend growth. So from a dividend perspective, things look pretty good. Yes, lower starting dividend yield like we would expect, but this company is reinvesting heavily back into the business and buying back shares, and we're still seeing double-digit dividend growth. So overall, I really like what I see here. But one of the key points that really differentiates American Express from their peers is their membership model. And I think there's a lot to like here. If we scroll down, we can see they have 4 outcomes to their membership model. Now, the first is attractive and global premium customer base, diversified and subscription-like revenue, and we're going to talk about that because that's a huge one, superior credit quality and performance, and superior loyalty and engagement with their global brand. Now you may be wondering, why do we think these are the outcomes? Well, we have to understand what American Express does. If we go over to their website, we can see the first thing, they provide premium credit cards. For example, look at the Platinum card. There's an annual fee of $700 just to use this card. So typically we're going to see people with much higher incomes than that of the average start using these cards. And that's what leads to the global premium customer base. Now there is more advantages like we'll see here in just a moment. If we keep scrolling down, we can see that their users have very high spending power. American Express has 3 times the US spend per card versus other networks. So people using American Express are spending quite a bit more than users using Visa or MasterCard. And then if we scroll down to our next slide on this investor's presentation, we're going to get to one of my favorite things about American Express, and that's their subscription-like membership fees. Now, I typically love companies that have subscription revenue. Think of great companies like Netflix and Costco. They've performed really well over the past decade, and American Express subscription-like revenue is a huge advantage for the company, and it also gives them a lot of pricing power. So for example, we can see US Consumer Platinum Card, 2023 versus 2021. They've increased the fee to use this card by 26% during this short time period. So this is the card we just looked at on their website, $695 annual fee. Look at US Consumer Gold from 2023 versus 2018. They've increased the fee to use this card by 28%. It's now $250 a year. So if we look at this next slide, we can see, yes, it does deliver a diversified revenue model, but here's what's really unique about American Express. Typically, when we look at the peers of American Express, most of their income is going to come from net interest income. This is typically around 85% for the peers, while 15% is spend and fee revenues. But look at this for American Express. It's vastly different from their peers. We can see spend and fee revenues coming at about 78%. So this includes merchant discount fees and annual card fees. So overall, American Express is seeing 5 times higher average annual subscription-like card fees versus their peers. And they're able to do this because they have such a premium user base. Their users are typically spending 3 times more than users of like Discover, Visa, or MasterCard. So their subscription revenue, yes, it's very predictable and it's easy to increase the price in order to increase their income over the years. But like I mentioned a moment ago, we also have to remember that this 78% also includes merchant discount fees. Now, what is a merchant discount fee? And it's summarized pretty well in this article. We can see when a merchant accepts an Amex card for pay, say around $100, it receives on average around $97.70 from American Express, while American Express bills the customer for the full $100, and the difference represents discount revenues. That's revenue going directly to Amex. But one of the key points that also differentiates them is American Express uniquely pockets the difference in full. When a similar transaction happens with other cards, the same difference is split between the network, Visa or MasterCard, and 2 banks, the merchants and the customers. So again, American Express is pocketing this difference in full, another huge advantage for the company. So we're already beginning to see that there are some key differences when it comes to American Express versus their peers. So now I want to quickly jump back into the investor's presentation, but first I want to take 30 seconds to say thank you to our sponsor. Today's sponsor is FinTalk. FinTalk allows you to get way more insights into dividend stocks just like American Express. If we scroll down here, we can see the company's dividend score, and they're completely transparent with how they came to this score. They're looking at things like payout ratio, interest rate coverage, and the dividend stability. If we scroll down, we can also see things like dividend growth over time and the dividend safety. If we scroll down a bit further, we can see even more key insights from analysts. But then perhaps my favorite feature is being able to generate a summary of a company's earnings call using AI. The first 20 people to click on the FinTalk link in the description will get a 20% off discount using code DIV20. Okay, so if we jump back into the investor's presentation, one of the things we have to point out is how strong the brand loyalty is for this company. We can see 2023 AXP billed business retention rate is 98%. That's really high. And then if we look at the 39th slide, we see what we should already know, and it's very easy to understand this. Their industry is still projected to grow at a very high rate moving forward. US consumer credit card billings are projected to grow at 8% annually. Now, if we look at American Express from a balance sheet perspective, a couple of key things we need to point out to this company is, first off, very high return on equity. That's a good sign. But look at the net debt to EBITDA over the past decade. It has drastically been reduced. So earnings before interest, taxes, depreciation, and amortization has gone up, while the net debt for the company has been going down. And we can see this reflected in the debt to assets ratio over time. It's sitting at a very healthy range as of the end of 2023 at just 0.19. So we can see total assets is way higher than the company's total debt. If we look back at the stock screener, we can see earnings per share has fluctuated a little bit for the company. They had down years in 2017 and in 2020, but overall, it's grown at a pretty high rate over the past decade, going from $4.91 all the way up to around $11.23. Now, one area where the company doesn't look quite as strong as Visa and MasterCard is when it comes to return on invested capital. We can see this is quite a bit lower than their peers. Now, over the past 3 years, it's been above 10%, which typically when I buy a stock in my portfolio, I want to see ROIC of at least 10%, and it looks like they're sitting at about 12.8 in 2021, 14% in 2022, and 2023 around 11%. So with all this being said, is American Express a good stock to consider adding to your portfolio at around $248? And to answer that, let's go ahead and jump into my stock valuation spreadsheet. We'll come up here and plug in AXP. And one of the things we can notice about the company is come down here, look at the beta sitting at 1.21. So you will see a little more volatility than that of the market. So you have to ask yourself, are you okay with that? If you're long term, it shouldn't bother you too much. Now, the first valuation we'll look at is going to be Graham's valuation, and this values a company based on this formula here. And basically what it does is it looks at how much the earnings per share is projected to growth while also taking into account current market conditions. So we have our estimated earnings per share average here at 13.57, and then we have our earnings growth rate projection, which is coming in at about 12, and they actually gave us some forward-looking guidance in their recent earnings presentation. We can see they updated revenue growth to be around 9% to 11%, which is in line with what it used to be, but they increased their earnings per share projected growth. So that's a good sign for the company and probably a big reason why it's up around 55% year to date so far. We can see they're projecting earnings per share growth to be 19% to 23%. So that's pretty high. Now we have to understand long term, it likely won't be that high, but moving forward, I'm going with around 12 for the growth rate projection. So then we divide by Y, as we can see right here, which is the current yield on AAA corporate bonds, and we come to an intrinsic value of $234.88 per share, pretty close to the current trading price. Now, the next valuation we're going to look at is going to be our discounted cash flow analysis. And we have to keep in mind, AXP's free cash flow has kind of been all over the place, so it does make it a little bit more difficult to perform a discounted cash flow analysis. But after applying all our projections, we actually come to a DCF price per share of about $368.36. Now, we're not going to use the multiples valuation in this scenario because this business model is just a little too different from Visa and MasterCard for my liking. So that means the last valuation we will look at is going to be our dividend discount model, and this values a company based on how much they pay out in dividends and how much the dividend is increasing over time. So in this scenario, we're going with a dividend growth rate projection of about 7.5%. So with a discount rate of 9%, we come to a dividend discount model price per share of about $201. So when we jump over to the output tab, we can see the three valuations that we used, and when we average them together, we come to an intrinsic value of about $268 per share. So with a 10% margin of safety, looks like our acceptable buy price is sitting at about $241. But the intrinsic value is still around 7.5% higher than the current trading price of the company. So American Express definitely provides a unique business model to its investors and to its users. The company has a nice growth runway set out for it, and if you're a dividend investor like myself, then I think you can continue to expect pretty solid dividend growth moving forward for the next decade. So go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling, and like always, if you'd like to be able to download any of my spreadsheets, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.